Google is ridiculously cheap and one of the most undervalued stocks to buy in the market right now. In today's episode, we're going to run through a lot of information. We're going to take a look at articles and understand why this company still looks so cheap. As we can see, this was written in April 2022. We can see in 2023 other articles talking about Alphabet, why it's so cheap. Year on year, this seems to be a very undervalued company. We want to understand why. We want to take a look at how they essentially make revenue, what are their top streams, and whether or not they are continuing to grow year on year. We'll also talk about whether or not ChatGPT, Bing are taking some of their market share year on year. And we'll talk about where they could be lacking in the future in terms of their growth. Now, as always, we will take a look at their top line revenue, how much it's growing year on year, as well as their bottom line net income. We'll talk about the health of the company, a quick total cash versus total debt. We'll compare them to others in the Mag 7 to see whether or not they are keeping up with the pack over the last few years. We'll also importantly look at the free cash flow per share, some very important financial metrics that you need to understand about Alphabet before investing. And we'll take a look at why investors and the markets are calling for Sundar Pichai's, the CEO's head, asking him to step down. What is going wrong with him and the way he is moving this company directionally. And we'll talk about not just institutional ownership over the last few weeks, but we'll talk about a lot of insider selling that we are noting by both the CFO and the CEO. And don't forget, as always, we're going to run it through the valuation model, get to the intrinsic value, acceptable buy price, using our investor margin of safety, and finding out what Wall Street are forecasting for the next 12 months. Now, within this, we're also going to take a look at the DCF model in detail, looking at the low, medium, and high growth rate for the future, so you can also understand where we are getting these price targets from and what our expectations are. So first, let's jump into the historical performance of Alphabet. Now, they are still up 44% over the last 12 months, something that it seems the market forgets as they have turned very bearish on this stock. They are in fact in the mid to upper end of the 52-week range with a forward P that now sits below 20, making it the cheapest company, or in fact the cheapest tech company in the Mag 7 based on the forward PE, and their market cap sits at 1.69 trillion. Now, bear in mind, if you have been holding this over the last 10 years, you would be up 361%, and we can see their all-time highs is within that 52-week range of $154. So let's take a look very quickly, and we have to understand firstly how Alphabet make their money. And the main thing I want to pull out from all of this information is that over half, so around 58% of their top line revenue comes from that search function that investors and the markets are believing other competitors like Bing, like Microsoft's ChatGPT are going to take away from Alphabet and their wide moat. So let's bear this in mind when we are analyzing this company today. Around 58% of their top line does come from Google search. One thing that is important to understand when you are investing in a company that has a very, very large portion of their income stream in one area is to ensure, like Alphabet, their advertising revenue, which is more than that 50%, continues to increase year on year. And that is what we are seeing, very strong growth, billions and billions of dollars every single year, and it is moving in the right direction that we want to see. So this is the first step of our analysis. No worries in terms of the advertising revenue increasing in the right direction. The next step is to understand now, whilst we have the information, so search engine market share in 2023, that at this point in time, ChatGPT has been out for several years, and we can see that Google still has an incredible moat. Their market share is around 91 to 92% of the total market, and we see Bing coming in at 3.19%, with a few other smaller ones coming in at around 1 or 2%. So there has been no real harm to Alphabet's wide moat, their search engine, still 92% after all the talk of Microsoft coming, taking their market share, which again we see no real clear signs of, and so far there are no worries over the next few years, or over the next 5 in fact to 10 years, of Bing coming and taking up a much larger position. One thing we do want to point out, now this is the US digital ad revenue growth by company in 2023, somewhere that Alphabet are lacking, although do bear in mind this is percentage change. They are at the lower end with around 3%. One thing we want to point out is that both Google and Meta will account for around 16% of net new digital ad spending growth, which is down significantly from around 80% in 2015. Something just to bear in mind to understand where they could really get harmful exposure to their top line and their numbers. But at the moment, no real worries, just something we did want to point out. Now, with this information, we want to take a look at their top line revenue growth. Now, typical companies, 3 to 7% growth is what we're after. For Alphabet, a technological company, increasing, we want to see a lot more. 162 billion reported on their top line in December 2019. 307 in December 2023. So we can see over the last 5 years, in fact, nearly doubled their top line. On top of that, on a more granular aspect, we see increases every single year. So this is a very strong sign of a company, increases year on year, as well as strong increases over a long time horizon. And we will shortly look at the last 10 years percentage-wise as well. Now on the bottom line, we do see some strong growth, 34 billion in 2019, more than double in 2023, their latest annual report, 74 billion. The only thing we would point out here is that year on year, we do see some granular inconsistencies with an increase from 2019 to 2021 before dropping, although we do see it rebound well into December 2023. So overall for Alphabet, both top line and bottom line increasing very strongly. And when we have a quick look at the total health of the company, cash and short-term investments have decreased from around 120 billion to 111, still a very, very large number. And when we compare that, remember, important to have a quick look at total debt numerically and directionally. We see that even though the total debt has more than doubled, or in fact nearly doubled at 16 billion to 30 billion, their total cash far outweighs this number. And when we will look at those net debt to EBITDA metrics, we will note that there are really no issues around that in terms of their total debt and cash. Now a quick look at their total return versus some of the competitors in the Mag 7. We have Alphabet up 44%, which I would say is a pretty decent return over the last 12 months, but we do note they are one of the worst performing in the Mag 7 over the last 12 months. When we expand that to the last 5 years, what we know, 136%, again, one of the worst performing. We see other companies like Apple up 310%, Microsoft 285%, Nvidia on an incredible run. But what I would say here, important to note, even though they have been one of the laggards of the Magnificent Seven, past performance isn't necessarily an indicator of future performance, so do bear that in mind. Now, very quickly, we will look at the institutional ownership. Now, it does sit around 35%, around 54 billion worth of sales by the institutions over the last 12 months, with a little bit more buying, as we can see over the same time period. On top of that, in the latest quarter, Q4, we do see more buying. So, over the last 10 months, in conclusion, institutions are buying a little bit more than they are selling. But in more important and more recent news, in Q4, we do see more buying. So we can see that institutions are quite bullish on Alphabet. Now, one thing we do quite like to look at is insider buys and sells. And what we know in fact, more recent times, just over the last few days, we see both CFO Ruth P. and Sundar Pichai, the CEO, sell a significant number of shares. In fact, just under $10 million worth for both of them. And we can see that the CEO has also sold shares at the back end of February for around 3.2 million. Now, what we would say here is that yes, insider selling isn't necessarily a great sign for a company, but it isn't necessarily a bearish signal. They do sell for a ton of reasons that we don't know about, whether it's personal or financial. But for transparency, we do want to show these so that you are aware and can make an informed decision whichever way you do. Now, before we jump into these financial metrics to take a look, what we do want to talk about very briefly is the CEO, who has come under a tremendous amount of pressure from the market and investors to step down as CEO. Now, it isn't just due to the recent AI debacle that has happened. There are many other reasons, but in more recent news, we can see that effectively the company was forced to pause their Gemini AI images for creating historical inaccurate images. In the previous episode, we did run through some of those pictures, so if you are keen to see what they are, you can either Google it or take a look. But essentially, a lot of people are unhappy with this. They do want to see Google take really control of the AI market, given that they do have a very, very large market share. And on top of that, we can see below here that he did in fact apologize. He did say that he knows that some of the Gemini's responses have offended their users, have shown bias, and he has explicitly said, to be clear, that is completely unacceptable and that they did get it wrong. So something just to bear in mind, yes, they have apologized, but if you are looking at a company that has a very serious moat in the search engine, it's taking up nearly 60% of their total top line, you would like to see them bring AI somehow to really throttle this company into the future and not become one of the laggards in terms of AI. So something has to happen. Whether or not he will step down as CEO, it will be interesting to see how the next few weeks and months pan out. But right now, the market is not in favor of him and his position. Now, before we jump into the metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below and you'll gain instant access. So let's jump into the metrics. Now, the free cash flow per share, always important to look at. The earnings is susceptible to manipulation by management through accounting. So personally, it is one that I would avoid. Free cash flow, 89 cents in 2014. Nice growth to 5.50 in 2023. Over the long term, while it may not be incredibly consistent, it is moving in the right direction. And what's important to note here is that in 2024, they are expecting this to increase to around $6.18. So they are expecting that continuation of strong, rapid growth to the free cash flow. And bear that in mind when we are coming to our valuation later, as that will be used as part of the valuation analysis. So in terms of the top line growth, I love to see double-digit increases nearly every single year other than 2023. You could argue it is starting to slow down by way of this graph other than the anomaly of 2021. But what I would say is 2023, even the 9% level is very strong. And I do believe the tide will turn here. We will start to see AI become very useful for Alphabet, although time will really tell whether or not this will be quick enough for this to be taken place with the current CEO, or it will be someone else in his position. Nonetheless, pretty strong over the longer term. And for those that like to see the numbers, numerically we can see it has gone from 66 billion in 2014 to 307 billion. So nice increases over the period. Now, shares outstanding, what we will say here is over the longer term, it is a share buyback. They have bought back 1 million worth of shares, or in fact 1 billion, which is very positive. That does return excess cash to investor pockets, but we can see from 2014 to 2017, they were also issuing shares, diluting your position. If you're a long-term investor, though, over the period, that would be very positive. They would have done that net share buybacks. And what we have noted from 2019, they have been consistently doing those share buybacks. In the more recent quarter, in fact, they did come out and say in the latest period, not only are they doing share buybacks, but they are expecting in the next few quarters to continue that process. So that is at least positive for investors. The thing that I would say is I wouldn't be surprised if over the next 12 months we do see an announcement of a dividend, given the fact that we did see Meta do this. Their share price did increase quite rapidly after. So it will be interesting to see whether or not this is something that the management team are thinking about as a way to increase their share price. And they also do have a lot of cash on that balance sheet, as we did analyze earlier. ROIC. Now, this is one of my 7 golden metrics. What I like to see, 10% or more, that does give me faith that management are able to effectively allocate their capital. We can see it has been increasing over the longer term, 15% in 2014, 28% in 2023, very strong numbers. Even the 15% is pretty decent, and over the last 3 years, looking very nice in the mid to high 20s. Operating margin and free cash flow margin, what I like here is that it's not only very strong numbers, but it is pretty consistent on both the operating side and the free cash flow side. 29% in 2023, very strong. 23% in 2023, very strong on the free cash flow margin side. No real worries, no red flag indicators, nothing to note. And finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. As we said earlier, 0.0000. It wouldn't even take them 1 day to pay off all of their debt net of cash on hand, given how much cash they do currently have versus that total debt. So balance sheet looking very strong and very healthy for this company, which does look to be extremely undervalued. So let's jump into our valuation model to get to essentially the intrinsic value of Alphabet today, arrive at the acceptable buy price as well. And if you do enjoy today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically we do run through every single model. However, for Alphabet, there are only a few that are appropriate. The first one we're using is the multiples valuation model. Companies in a similar sector and size, and those that are in the Mag 7, we have their P multiple. We get the average P multiplied by the EPS of Google to get an intrinsic value of just under $188. And we have that signal of undervaluation. Do bear in mind, though, we don't look at any of these models in isolation. Now, the second model, it isn't one that we're using, although it could be one that we could be using over the next few years if they do start to pay that dividend. So what the most important, in my opinion, the DCF model, we have the free cash flow year on year for Alphabet. Average growth, now that is 24% over the last 10 years. Forward looking, we have gone for 12%. Now, using that with the discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get that intrinsic value of $214 with our undervaluation signal. Now, as we mentioned, we do have 3 targets here, a low, medium, and high, and essentially we have used the 12% as what we believe to be a low target. Now, the reason for this, the 12% is much lower than the average growth rate of 24% that they have obtained over the last 10 years, year on year. It is also lower than what analysts and management expect for 2024. So we do believe this to be a fair low rate, giving upside purely on the DCF model of 58%. Now, if we were used to use the medium, which we have here as 14%, that would give an intrinsic value of $245, as we note here, giving upside of 81%. Now, what we believe to be a high target of 16%, as we can see here, would give an intrinsic value of $281, upside of 108%. Now, these are all different targets, and if you do grab a copy of this model in the pinned comments below, you can run around with different numbers based on your own estimates and analysis, whether that's for Alphabet, whether that's for companies in your own portfolio, or those on your watch list. Now, for today's episode, we are going to go ahead to the final model with 12%, as we do believe that to be a fair low value, conservative, but as always, do let us know your thoughts in the comments below. So the intrinsic value in today's episode is the DCF model that we just ran through on a low basis with the multiples valuation, giving an average of intrinsic value of $201. Now, the current price at $135, we do use a margin of safety of 10%, and we use that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So if we use that, it is a buy up to $181. So right now, we are looking at a much higher MOS level than 10%. We keep going till it's near the current trading price, and we can see for today's episode of Alphabet, it isn't quite there yet at 35%. So we see around 30 to 35% of a margin of safety, which for a tech company is very, very large. Now, in terms of Wall Street and their forecast, well, they have a price target of $170. They see upside of 26%. So they do see this as a very, very strong buy. Now, as always, though, I'm interested to hear your thoughts, whether or not you do believe, firstly, that this is an undervalued company, whether or not it's cheap, if you have been buying, if you're waiting for a certain price, and I'll also be keen to hear about your thoughts on the CEO, whether or not you do believe it will be better if he was to step down and someone else was to take his place to really bring Alphabet back to what it should be in terms of the search engine, in terms of using AI and Gemini and taking this really forward on that AI approach. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.